Daniel Kahneman, a psychologist who won the Nobel Prize and wrote the book Thinking, Fast and Slow, says that regret is the biggest threat to your financial health. At a recent Morningstar conference in Chicago, Kahneman talked about his plan for investing that leaves no room for regret. He and his friend Amos Tversky came up with the idea of loss aversion, which is the idea that losses hurt more than gains do. Kahneman and Tversky show that people don't deal with uncertainty by looking at all the information carefully and logically. Real people, on the other hand, use a lot of mental shortcuts along with their feelings to make decisions. Two portfolios are needed to solve the problem. Kahneman took this idea further and came up with the regret minimization strategy while working at Guggenheim Partners with a team that did what he called financial advising for very wealthy people. Kahneman thinks that investment planning needs to find a balance between making as much money as possible and having regrets. To do this, you need to know who the investor is. He says that the best plan for someone who tends to regret things and the best plan for someone who doesn't tend to regret things are really not the same. The best way to invest for most people is to have a plan for when things go wrong and stick to it. This is easier to say than to do, because you can think about what could happen. But it's harder to imagine what it would be like if it did. Kahneman's idea was to plan for the possibility of regret, including the possibility that they might want to change their mind. We asked people to try to imagine different situations, most of which were bad, Kahneman said. The question was, at what point do you think you would want to give up? That you want to change your mind. Kahneman would ask investors how much of their wealth they were willing to lose. 10%, 20%, or 30%. The next step was to get people to think about how it would feel and what they might be tempted to do in that situation. Most people, even the very rich, don't want to put too much of their money at risk, so they usually choose a number around 10%. The team came up with the idea of making two portfolios, one risky and one safer, based on each investor's regret propensity. Then, each portfolio is managed and reported on its own. This creates a mental distance between the two investments and makes the investor feel safer, even though they are both in the same portfolio. Most of the time, one of the portfolios does better than the market. This means that when something does go wrong, investors are less likely to panic, feel regret, or want to change their minds. Kahneman says that it is helpful to remember that you thought about how it would feel if the value of your investments dropped.